Hi, thanks for tuning in. This time I thought we'd look at bullish absorption, and more particularly as a form of accumulation. Bullish absorption has always been present in the markets, and I've found it more common to be used to push price through an area of resistance above. There's two ways the market can push through resistance like that. It either rams itself straight above and then goes into the consolidation process, or the market grinds its way through, sort of in a fashion like this. And this is the bullish absorption that I look at. And just for a quick refresh, the characteristics of bullish absorption are a pressing nature towards the upside. You can see on this little chart here, price is pressing higher. Tight clustering of closes, which suggest absorption is taking place. You can see some clustering of closes in here. And threatening down bars, which have little or no downside follow through. You can see some down bars here that at some stage during their period, the market would have looked like it was going to move lower, particularly on this one where it closed low. These ones here would have pushed low during the period of that bar, and while it was trading at its low, it would have looked like it was going to break down and move lower. But each time, the next bar was up in response. These were threatening down bars with little or no downside follow through. The chart we're going to look at is AZJ on the Australian Stock Exchange. It's a transportation stock. It owns railways. It moves bulk commodities like coal and wheat, and it's generally considered an income stock, which produces a good, strong dividend. It doesn't usually have a great deal of growth. It's not known as a growth stock. It's a income stock, and it's pretty obvious that prices gap down here. I wanted to show you this. This is the daily chart. I wanted to show you this first. I'll move to the weekly chart shortly, because I wanted to show you how difficult it can be to read a market when it's in the accumulation phase in particular. There's lots of overlapping bars and bars that don't quite make sense. You have to remember, this is not a market in the markup phase. This is a market that's going to be accumulated. Prices gap down here, which we'll look at shortly, and you've had some form of climactic action. It's probably not really a true selling climax, although it might be a minor selling climax. You can see the increased amount of volume as price pushed lower here. But for instance, look at this little bar here. It's a lovely little test bar. Volume was very low. Spread was narrow. Remembering, a test for supply like that is a narrow spread down bar closing mid to high on low or below average volume. That's exactly what it is, and the response is exactly what you'd expect. A push higher, then another test and a secondary test and a continuing push higher. But this time the push higher wasn't supported. You can see down here the volume is low here. The market doesn't want to go higher here. It wants to go back so that it can accumulate. And then in response, you had the market go lower and it's lost all of its gains. If you were trading it on very short term, well, if you were trading on a very short term, you'd be using a smaller time frame than this. But the market isn't trending higher. I guess it is overall like this, but it's not really in the markup phase at all. And look at this little bar here. Narrow spread down bar closing mid to high on low or below average volume. And I think you'll find that is the volume there. Now you would expect the market to go up in response, or at least perform a secondary test. And it kind of did perform a secondary test, but it's closed at or just below the low of the previous bar, and then the market's continued lower. This was like a failed test, but it was a failed test more because it's traded in an accumulation zone and not really as in a markup phase where you would have seen a much different response. If we switch to a weekly chart, you'll see how much more clear the price action is. Here was your gap down and possible selling climax. Now, at the time, price was trading sort of through here, and they came out with some announcement about buying another railway, reducing their dividend to some extent for a period of time. There was some sort of risks involved. It was probably made out to be far worse than what the risks actually were. The professionals in the market like to amplify these risks to create situations just like this and then mark price down really sharply and threaten the market, put out news in social media and financial media to say how bad it is that the company is going to reduce its dividend or whatever it was. They amplify the bad news and put a really bad gut feeling into the market. They use it to their advantage. So as prices gap down, here's the gap. And just so we're clear, this is the traded range of that weekly bar, but this bar actually moves right up to here, and this is its true range, not its average true range, its true range. That's the true range of the bar from the previous close in either direction. And the traded range is the range that it traded for over the period of the bar, which is weekly in this case. So what actually happened? Market rammed down, volume was really high, but it did close back almost at mid-bar, and it closed back adjacent to the previous support level to the left. You could effectively say this was buying in here. The market bought this. And you can see on the next bar, price moved up in response, but then, and this is another tactic you'll see commonly, price is allowed to move lower or is forced lower by selling some stock or shorting the price down, because the market wants to accumulate, or the market, you won't know at the time, you're just reading it at this point, but the market wants to accumulate. So they move the market lower and then buy it up like this. So they've moved it from, this is the automatic reaction, which confirms the buying down here. Then price over a week and a half, let's say, is moved back down to the lows of the range. Here's the lows of the range here. And then the market buys it up. It's then allowed to move lower again and buys it up. And it moves lower again and they buy it up. This is exactly what you see. Now, let's just clear that off a little bit. Here's the gap again, so you can see. Now, let's see what we've got here. It's much more clear on the weekly chart. You've got a market with a pressing nature towards the upside. You've got clustering of closes at similar price levels. This suggests absorption is taking place in the market. And you've got threatening down bars that show little or no downside follow through. You can see each of these down bars, which look like price could go lower in response, sees an up bar following it. I think we see this form of bullish absorption used as a form of accumulation, partly because markets are getting a little smarter, or the traders within the markets are getting a little smarter. Where previously you would have seen a accumulation zone following some form of climactic action move more like this. it's much harder to get these big swings now because the market sort of knows what's going on, at least to some extent. And we see this form of bullish absorption more, where price just steadily moves higher in a grinding fashion, like this. And now you can see this market has broken out. You might find that the highs of the old range are actually tested at some point for strength. If that's found to be strong, I expect this market might attempt to move higher like that. We'll just have to wait and see. Now, I just should point out that the most interesting bar and the telltale sign at the time, at perhaps the earliest possible time, was this bar here. This bar here showed a much narrower spread, and volume actually increased over the previous bar. Price didn't move below the climactic bar's low, and the next bar was up. When spread narrows like this, especially on an increase in volume, and the close is well off the weekly lows or the bar's low, it's a good sign that buying has come in, and an up bar in response just confirms that buying. This up bar showed no upside follow through, but the market didn't want to do that. It wasn't in a markup phase, it was in an accumulation phase. So what it wanted to do was bring price back down so that it could buy it up again at the lowest possible price, and then bring price down, and then buy it up again at the lowest possible price. Down, up, down, up, down. That's what this market's doing. It's trying to accumulate at the lowest possible price, mostly within the range of the initial buying. Here's an example where price shifted down pretty sharply, about 40% over 3 weeks. But this time, the next bar wasn't up at all. It was down. It remained within the range of this climactic bar, but supply continued to be drawn out at the time. And this was during when COVID was first announced. The talk in the market was very negative. So more supply continued to be drawn out. Although note that volume increased, but spread narrowed considerably. So there was some buying in there. The buying probably came up to this level. So here was your buying level. And I would imagine as the price pushed lower, the market continued to buy. Just gently, they weren't pushing price up, they were letting price come to them. Then you had like a shakeout bar. Volume was still well above average and very high, but volume reduced slightly. Mid-bar close, next bar up, spread had narrowed, and then the market went through another period. There wasn't really a pressing nature to the upside. There was threatening down bars with no downside follow through, and there was clustering of closes all at the same level. This was absorption taking place. In fact, this was the market milking everything it could get at that price level before there was just no supply left. Look at the volume down here. Volume was reducing to well below average. There was no supply left down here. Everything had been bought. Price popped up. And then they really went through a further period of absorption as best they could through here before price really started a markup phase. COVID was at least dying down to some extent, or the threat of it, and the market started to move higher. If I remember rightly, price went up for a considerable period of time following that. This market's live at the moment, so that's where we're at. We're back on the AZJ chart now. So that's bullish absorption being used as a form of accumulation, and it's becoming more common. You're less likely to see a true sideways accumulation zone form in response to some climactic action, especially in larger cap stocks, where a lot of the professionals are all trying to pile in at the same time. They still want to buy at the lowest price possible, and that's why the market does these threatening down bars and these bars that look like up thrusts that close really poorly. They don't want the market to take off and move higher. They want the market to move back lower so that they can buy it back up again in a buy the offer fashion at the lowest price possible. That's what this is all about. This is about accumulating at the lowest price possible. And they've got to buy large amounts, these professionals. They're not able to do their accumulation in one purchase. They're purchasing over a period of time. Most accumulations take, on average, 12 to 16 weeks. This one was 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14 weeks. So right in the average, between 12 and 16 weeks for an accumulation phase. Here was the old range there that price had been trading in, moved above it now, and there's some chance price will test that level for strength. We'll just have to wait and see. It may continue higher here. That's bullish absorption used as a form of accumulation instead of what you might call a standard or regular accumulation zone. Thanks for your time. Thanks for tuning in. See ya.